This presentation summarizes our FIN332 group report, which explores two major areas of modern trading: algorithmic market making and option strategies. The first part, AlGO2, focused on developing and testing a VBA-based trading algorithm designed to provide continuous liquidity, manage inventory risk, and capture profit from the bid-ask spread. The second part of the report examined a range of option strategies, analyzing how their profit-loss outcomes respond to different price movements and expiry conditions.
Before looking at the code used to automate the trades within the case simulation, it's important to understand the limitations that have been set. Firstly, there is a max position of 25,000 shares. There is also a 1% trading commission per share on all active liquidity. Then there is a 0.5% rebate provided on all limit orders that have been filled. And finally, a 10-cent fine per share when a trader exceeds the maximum position of 25,000. We now must understand the desired goals of this case. Algo 2 looks to achieve the benefits similar to that of arbitrage by presenting two simultaneous orders, buy and sell, with the price variation being set at either desired spread, either dynamic or fixed. It then wants the trader to collect the spread difference as well as the rebates of filling limit orders while maintaining a low inventory balance to reduce the amount of commission costs. Finally, it wants the trader to integrate measures that allow for the code to recognize trends in the market and attempt to change the spread variable and to enhance both holding security value and opportunities for arbitrage. While we review the results from conducting the simulation, we must explore the variations made to the base code provided for this case. The beginning of the code represents both the initializing link between the Excel and RT software and the first method of inventory management. By enabling Excel to provide real-time updates of the case being simulated within the software, it allowed for better integration of dynamic measures such as a spread, which required for the most current bid and ask price. The inventory management aspect of this code was decided based on the set volume of orders, which was established to be the most efficient at 1,500. This was based on constant trial and error that saw the greatest benefit of the rebates, as well as maintaining a low inventory as close to zero as possible. The next section of code is fundamental to this case by ensuring that there is always pair orders within the order book and cancelling orders if they do not match this set condition, thus ensuring the inventory position and limit orders always match the trend of the market. The final section of code represents another form of regulation against holding risk and inventory management. By assessing the current limit orders being placed, it will refresh the order book if the price set for the pair orders somehow falls outside the desired price range. I made sure to note the differences of results when conducting the simulations and have decided to pick four samples of testing to provide insights to how altering code and factors within the Excel spreadsheet impacted the end result of the cases for both better and for worse. The initial sample 1 result was produced by utilizing a volume order size of 1,500 and a dynamic measure of spread to be used for limit order submissions. This was followed throughout all the different sample results as well. Key points to be noted from this sample includes a high level of volatility in the algorithm's interpretation of the market trend. With inventory risk being high, it resulted in the highest accumulation of commissions and asset price fall. The second sample provided an improved measure of volatility based on a far more strict inventory position limit, thus forcing the trader to sell at the last ask price whenever the position exceeded 7,500. The third output highlighted the effectiveness of the price regulation code by constantly monitoring the spread compared to the last submitted order, and it allowed for the automated cancelling and reordering, which saw the most amount of trades to be achieved and earning the highest amount of rebates. The final sample represents a far more accurate version of the previous price range monitor, while having a lower amount of completed trades at the highest amount of order submissions and the highest realized P&L.
Key takeaways. In the AlGO2 case, our algorithm performed strongly in several key areas. Inventory management worked efficiently, keeping our net position close to neutral through continuous paired orders. The trade order refresh feature maintained liquidity by instantly replacing filled or unbalanced orders. Most importantly, the dynamic spread logic allowed the algorithm to adjust to market volatility, tightening in calm conditions and widening during higher volatility periods. These features produce consistent profitability in stable markets. However, limitations included difficulty testing under volatile conditions, fixed order volumes, and parameters that depended heavily on the simulation environment. Looking ahead, there are clear opportunities for refinement. Technically, we plan to introduce volatility-scaled order sizing, integrate previous price data into the code, and add profit and loss sensitive logic that adjusts orders in response to unrealized gains or losses. Strategically, the algorithm should be tested in both stable and trending markets, alongside including hedging for correlated assets, using penalty rules for large inventory drift, for example, automatically widening spreads or reducing volume when exposure grows. Overall, AlGO2 confirmed that dynamic spreads outperform static ones, and that true profitability depends on flexibility and control. By incorporating volatility awareness and adaptive features, the algorithm could deliver even stronger performance across varying market conditions, achieving stability, efficiency, and consistent returns.
So part 2, our options trading. I'll speak through the strategies, Tomi will dive into the diagrams, and then Marijana will finish off with the rationale. Starting with our first strategy, the straddle. This strategy involves taking positions in both calls and puts with the same strike price and expiry. In the simulation, we were asked to build 50 short straddle positions at a $52 strike price. And to construct these positions, we sold 50 call options, $52, and 50 put options at $52. Now, the outcome of this was a total profit of $7,650, with $3,650 coming from the calls and $3,000 from the put options. Now, this here demonstrates how a short straddle can perform well in low volatility conditions. And this is where the asset price, the underlying asset for the options, remains near the strike price, and the premiums collected are then retained as a profit. Now, that was the straddle. If we move on to the strangle, the strangle strategy takes positions in calls and puts, both with different strike prices. So with this particular simulation ask, we needed to build 60 long strangle positions. And this was by using put options at a $49 strike price and also call options at a $52 strike price. Now we bought 60 put options at $49 and 60 call options at $52 to construct these particular positions. The outcome of this, we got a total profit of $32,400 with a loss of $7,620 from the puts and a gain of $40,020 from the calls. Now, this here shows that long strangles can be highly profitable in high volatility markets, especially when the underlying asset moves significantly above the upper strike price, which in this case was the $52 call option. So the underlying asset price moved well above this, which resulted in our $40,020 profit with our calls, and then this sort of balanced out, brought it down with our put options that did get that negative profit or loss. Now, if we move on to our third strategy, this is the butterfly strategy. And this combines multiple options to create a limited risk and reward profile. So that the benefit of this is that in most cases where your upper and your lower limits are. Now, in this simulation, we were asked to build 60 short butterfly positions using call and put options with strike prices at $46, $52, and $54. Now, the building position of this was we were buying 60 puts at $46, buying 60 calls at $54, selling 60 calls at a $51 strike price, and also selling 60 puts at the middle strike of 51. Now, the outcome was a total loss of $15,840, and the middle strike options contributed most of the losses, with the $51 calls losing $7,800 and the $51 puts losing $12,900. The outer strike options made smaller gains, $2,160 from the $46 puts and $2,700 from the $54 calls. Now, this demonstrated that the short butterfly can be risky when the underlying asset, when it doesn't move enough to make the outer strikes profitable. And as a result, there was approximately $16,000 loss in this simulation. Now we'll move on to our last one, which is the condor strategy. So, and this is a four-legged approach, which is designed for low to moderate volatility. So in the simulation, we were asked to build 50 long condor positions using strikes at $47, $49, $50, and $52. Now the build positions, we bought 50 puts at $47, we bought 50 calls at $52, and we sold 50 puts at $49, and also sold 50 calls at $50. Now the outcome of this, total profit of $5,100, and when we break it down, the $47 puts lost $20 $2,950, and $49 puts gained $4,200. The $50 calls gained $8,600, and the $50 calls lost $4,750. Now, this here shows that how the condor strategy can generate moderate profits when the asset price moves within that expected range, while also limiting our overall risk.
The short straddle strategy payoff diagram illustrates the outcomes which involve selling both a call and a put option at the same strike price as well as the same expiration date. The payoff diagram takes the shape of an upside down V, showing the maximum profit earned when the underlying closes at the strike price of $52. Both options expire worthless and the premium is collected by the trader. As the underlying moves away from the strike in either direction, the seller starts to lose money and the losses rise in a linear fashion as the underlying moves further away. This represents unlimited risk to the upside if price increases and substantial losses to the downside during a decline. The break-even point is set at the strike price plus and minus the premium collected by the trader. The strategy targets a low volatility scenario and its risk is derived from volatility. The combined strangle payoff diagram represents 3 strangles, 2 short strangles and 1 long strangle. The chart's V-shape shows that the portfolio was net long on volatility, meaning the substantial profit was generated by the long straddle in the high volatility environment. Meanwhile, the 2 short strangles targeted smaller fixed profits within a low volatility range. When the underlying price moved sharply above the higher strike price, the long strangle return pushed the net payoff into the significant profit region. The butterfly strategy payoff diagram shows an inverted tent shape, which represents the strategy's goal to profit from high volatility. The diagram's lowest point, the maximum loss zone, occurs when the underlying price expires at the middle strike of $51, where the 2 options were sold. The strategy achieves its capped maximum profit if the price moves sharply and expires outside the lower or higher strike prices. The resulting loss is consistent with the price failing to move significantly and settling close to the middle strike price, creating a loss represented by the payoff diagram. The long condor strategy payoff diagram displays the characteristic plateau shape, showing its target of profiting from low to moderate volatility. The flat section at the top of the diagram represents the maximum profit realized when the asset price expires between the inner short strikes. The realized profit indicated the asset price settled within the broad profit range, specifically allowing the inner short options to expire and retrieve a return consistent with the strategy's aim.
To rationalize the results of each strategy, the underlying asset will be assessed on its price, movement, and volatility, matching the profit profile of the constructed position. The short straddle strategy was a low volatility play, with the objective of profiting from the combined premiums collected. The realized profit confirms a low volatility market environment and that the asset must have settled near at the strike price. Therefore, the options were able to expire with minimal intrinsic value to maximize the net credit retention. The short strangle strategy is also implemented in a low volatility environment. The successful profits indicate that the market's low volatility ensured the break-even point was not crossed by the asset to allow for the collected premiums to be the profit as the options declined in value. The long strangle strategy is a high volatility strategy that achieves a profit due to the underlying asset price moving above the strike price, making the call in the money to gain large intrinsic value. The gain compensated on the loss from the purchase put option confirms a capitalization on a directional shift. The short butterfly strategy is a high volatility strategy. However, the loss suggests the market experienced low volatility. The minimal gains from the outer legs of this strategy reinstates that the price did not move far enough for profitability. The long condor strategy made a profit due to the sold options expiring to be worthless but retaining the premium and generating profit. Whilst the outer options also expired worthless, they lost their initial premium cost. This portrays a successful strategy for a low to moderately volatile environment.